Good afternoon, welcome to the Business BoardCast. My name's Nikki Larkin. Today I'm going to be very finance focused, but at an introductory level, what I find when I'm speaking to business owners, whether it's regarding their accounts or whether they're looking to sell their business, there is a very variable level of financial language knowledge. Some people are really, they know their numbers, they know the terminology, they quite honestly, they could be an accountant, they're so good. But you've got others that are very limited on what they know, no fault of their own. They've just, not been through the education. You don't have a finance class in school. So they don't know what the basic terminology is. They don't know how to look at reports. So today, I'm going to take you through some key terms. I'm also going to take you through a set of statutory accounts of the number side. We're going to have a look at Sainsbury's accounts because everybody will be familiar with that business. So let's have a little nose around. So I'm going to take you through from the beginning on the basic jargon to looking a bit more in depth at a set of accounts, and then also some other tips of things to look at, and also looking at perhaps looking at your profitability in a different way. As always, please do ask me questions as we go along. I'm on my own today, so apologies if I'm a bit slow getting to the questions, but I will look at them every so often. So please do say hi, so that I know that there are some people watching live. I know it's a very lovely sunny day out there. I was invited to a lovely event today, but unfortunately I didn't get much sleep last night, so I'm having to skip it. But there is, lots of people I know probably maybe off for Easter, etc. But if you are at work or if you are watching live for whatever reason, thank you. Please do say hello and do ask any questions along the way. As always, no such thing as a silly question, because if you're thinking of it, I'm pretty sure there will be lots of other people that will be watching this at some point that will have that question. So it's super helpful to put that in, because, I've been an accountant for 30 odd years. I sleep, dream this stuff. So I live it. So it just becomes, it's just part of my day. Whereas when you're running your business and you've not had to look at accounts or anything before, it can seem all a bit alien. So please do ask and we'll go through. So let's hop straight into it. So I've got little prompts today because I am going to be showing you some actual accounts. Just wanted to go through the most common terms. I was trying to come up with the top 5, but actually it had to squeeze into 6 because it just didn't make sense only having the 5. So these are probably the 6 ones that you probably hear the most. So profit, that's essentially when you have your sales in your business, then you have your costs, and that's what's left over is your profit. There's different ways and different types of profit, but at the moment, we're just concentrating on the fact that there is profit. Don't get confused with gross profit, because gross profit is only taking into account your cost of sales. So, for example, if you were a painter and you were, so as in a house painter, not a Michelangelo, but a house painter. So you might on your profit and loss account have your sales. So charging for, painting a nice 4-bedroom house, whatever. Perhaps you're charging a few thousand for that. Then you'll have your cost of materials, so your cost of sales. So that will be probably for the paint, masking tape, whatever else. You may put in labour charge if you've got subcontractors and things in there, but you may not. But that is then your gross profit. It's typically your sales less the cost of the people for that job and the cost of the materials. That's your gross profit. So don't get complacent and think that, gross profit and that's it, that's great. There's still a load of costs underneath. Often you've got your administration costs, advertising, legal costs, professional services costs, insurance, lots of different things. So you have to take all of those out to get to profit. So that's term number one, profit. Second term is revenue. Now, this is where it gets so confusing sometimes because there's so many different words for the same thing. I've put in revenue. Equally, people may call it sales, we might call it turnover. So all essentially the same thing. It's how much you're selling to your clients. So it's either selling your products or your services, and that is your revenue. So it's the money coming into the business for your products or services. The third thing is your debtors. So, I mean, people might not think, oh, debtors and creditors, why should they be in here? But I think there are key things in the account, so it's important to understand. So debtors, you'll probably be thinking most of perhaps your trade debtors. So the people that you've sent an invoice to, but they've not paid you as yet. That is a debtor. You may have other debtors in there because there might be other people that owe you money as well, but the most common one is your trade debtors. The next one, similarly, but the reverse side is your creditors. So that's where you owe money or your business owes money to other people. That's your creditors. So it may be for your supplier invoices. So you might have an invoice that you need to get paid, so they'll be in your creditors until you've paid it. It could be a creditor, it could also be perhaps your overdraft or a short-term loan, or even a long-term loan, because we've got just creditors in there. We haven't said if they're long or short-term. So basically, it's anything that's owed money. Also, things like tax. Often, if you're usually in a situation where you're paying out tax, in your creditors, you'll also have your PAYE, your VAT, corporation tax, etc., all being creditors. No one likes creditors. We want to have debtors. And in fact, we don't even want debtors. We'd rather them pay as well and have it all in cash. Anyway, next one, income statement. Now, for those older amongst you, such as myself, we're more used to saying profit and loss account. But essentially, income statement is the same thing as profit and loss account. It's essentially it's just stating your revenue, your relevant costs, and getting to net profit. I will show you one shortly so you can actually see one in action and we can unpick it. But it's really important to make sure you've got. I see too many businesses only looking at their numbers once a year, so they've got no clue of their income statement. We were actually going through our Orange Accountants clients yesterday looking at, we've got lots of clients that do have management accounts, some that have them done internally, some done by us, but there's also a lot of clients that don't have them done very often or don't have them done at all. So they've got no clue about what their profit is until the end of the year. So I do encourage people to run their income statements more regularly. In fact, with the introduction of MTD that we talked about 2 weeks ago with Olivia, if you want to go and have a look at that, if you're a sole trader or rental properties and things, you will have to be doing them on a quarterly basis anyway soon. Balance sheet. Now, this one is something that, is confusing. I remember even when I was originally studying back in the 90s for my exams, balance sheets can be a bit confusing. Obviously once you've been doing them for a long time, it makes more sense. But balance sheets are essentially, is a good way to look at them, is they're essentially, if you liquidated your company today, what would be left? So it's the amount of capital and reserves that would be left. Balance sheet as well is it's the double entry part. So I'll show it when I show you the example in a little while. It'll probably make more sense. But essentially, your net current and liabilities, current assets and liabilities on your balance sheet will equal your capital and reserves. Because it has to balance. The key's in the name. People do get confused in it and not so sure about it, but it's a really important thing to be looking at and seeing the state of play of your business. And so we will be looking through Sainsbury's balance sheet as well, having a little nose. Okay, so here we go. Here's Sainsbury's. So I thought this was a good one. Any limited company or PLC or limited liability partnership, their accounts are on Companies House for public view. At the moment, only if you're a sort of a bigger type business that you'll have your income statements on there. That is changing soon. So just be wary of that everybody's going to be able to see your income statements. I think it's in about a year's time or so, depending on when your year ends are. But anyway, here's Sainsbury's Supermarkets. So just to look at one thing, always look at the values here. You can see, so I'm not sure if this will show it, but you can see these are all in millions, because obviously it's a large business. So some accounts are just done straight in pounds, some are thousands, some are millions. Always make sure that you can see what the key is on there of to see what the actual volume of these numbers are. These are in sterling. You probably expect all UK accounts to be in sterling. That isn't actually a technical requirement. They don't have to be shown in sterling. I've worked in businesses before that are mostly trade in dollars, so in shipping, for example, and those accounts are showed in dollars rather than sterling. So you can show your UK accounts in sterling or dollars or euros or yen or whatever you want, as long as you say what it is, so it's obvious. And you do have to convert it when you go to your corporation tax, etc. But that's going on from the basics. Don't need to know that today. But what you can see here, so you're showing what they've got here is they've got the period up to 2nd of March 2024. They're a bit different. They do it on 52 weeks rather than a full year. So they've got 2024 numbers versus 23 here. You can see that the revenue, so the amount that's sold in those supermarkets, was 27.8 billion in 2024. That would be all nice. We'd all like to have a little slice of that. And the previous year, so significant increase. It's gone up a whole billion from the prior year, from 26 billion up to 27 billion. Probably no surprise with all the inflation. Doesn't necessarily mean they sold anymore. They just the prices went up. But that's me being cynical. We haven't got the data here. Probably further into the accounts it says things like that. But anyway, you can see what the revenue is. You can see how much was sold. You've then got the cost of sales. So that will be the literal the cost that they bought the products for. Probably it's got some costs of sale and things in there, as some other costs of sale in there, such as labour, etc. And you can see they've got very significant costs in there. This isn't a type of business that's running on 50% gross profits. This is very marginal, but because there's such high volume, it's why it's so important, why it still can make such a lot of money. But the actual percentages, it's still not very significant. So it's made gross profit level. It's actually done really, really well. It's gone up 50%, the gross profit level. It's gone from 1 billion up to 1.5 billion, which is a fantastic increase, 50% increase, because as you can see, it only had about less than 5% increase on the sales. So that's phenomenal cost sales. They've obviously really passed along to the consumer those extra costs. They might have had some one-off costs last year as well, but we'd have to look at the detail to see that. Then you've got the administration costs. So this will be for their head office, probably some advertising and things like that. But you can see they are very substantial as well, and that has gone up year on year. In 2023, there was 800 million, and in 24 is 956 million. So, so that's, and then they had other income. So other income will be from other things, like it could be interest, it could be some grants, all sorts of different things it could be, but it's usually non-core activities that go into other income. And that ends up with their profit. So 2023, they made operating profit of 500 million, whereas this year it's 600 million. So from 500 million up to 600 million. So nice increase, which is great for them. Just to let you know in context, because you'll probably hear me doing valuations all the time, I did see that a few weeks ago the valuation of Sainsbury's was 5 billion. So it's a 10 times multiple. I'm sure it said 5 billion. I'm now starting to doubt myself, but I'm pretty sure it said 5 billion when I was looking the other day. So this is you don't get this when you're a small business because you think but it's because of the volume and everything, and it's serious numbers. So you can get quite very good multiples on there. Let me just double check that valuation. I'm very sure I didn't dream it. Anyway, yes. So the next part is you've got the operating profit. So you think, well, surely that is just the profit. But no, what they do in accounts is they then put underneath the finance information. So there you've got the finance income, so some interest. So that is different to that other income. So that probably wasn't in there. They split it out. And then you've got finance costs. So obviously, with the supermarket, I'm sure they have huge amounts of finance costs with, they'll have the costs from, well, I don't know if they put them in there because they might put it offline, but you think about, every time that you use your card in the supermarket, that's a cost, but it could also be for just servicing their debt. That could be the cost in there, possibly. But anyway, good news is they still end up with a profit either way. Even though they've got substantial finance costs, they still end up with £273 million of profit. And I'm sure none of you would be saying no to that, because that sounds very nice. They've then got an income tax expense credit, so that's just adjusting for how the income tax will look. So they're paying 69. They're expecting to pay 69 million of corporation tax. So contrary to what a lot of people say on the big businesses not paying any corporation tax, it looks to be that they are this year, last year. So that's there. So these are big numbers, but your accounts won't look any different, whatever size you are. It's 5 billion. Anyway, they will look the same. It just unfortunately we probably have smaller numbers, but that's what the income statement will look like. Next, we're going to go into the balance sheet for Sainsbury's. So we've got in here, you've got the top part of the balance sheet is the non-current assets. So it's the fixed assets. So it's the stores, it's any equipment they've got. They've got some derivatives in there as well, which is just like a financial instrument. And they've got their pension scheme on there as well. So you've got that's their top bit. Then they go down to the current assets. So you've got the inventory. So that's just another word for stock. So that's how much is in their warehouses and on their shelves. You've got trade and other receivables. So you'd always think that actually they wouldn't have anything owing to them, but it probably is the timing difference in when you have your credit cards and things, because so a few days credit card timings is obviously substantial numbers for them. Then you've got the tax receivables, so they must be having some refund of some tax coming in, probably from VAT, I would have thought. You've got a bit more of your derivatives, so another thing that's probably hedging, because they're probably something like that they're probably doing. And then you've got their cash, so they've got some cash. Their cash has gone down a little bit. And then they've got some assets that they're holding ready to sell. So those are their total assets. So let me just check. These are all still in the millions. Yeah. So you've got 18 billion assets. Last year they were at 19 billion, so they've gone down a bit. But current liability. So this is the things that are owed out to other people, other businesses. So you've got your trade and other payables. So I don't know what their terms are. Wouldn't be surprised they're on 60 days, 90 days. A lot of these large companies are. But so you've got a significant amount that they owe to other businesses, touching at 4 billion at the moment. You've got some lease liabilities, so that will be where they don't own some of the stores. They won't actually own; they'll just be leasing, and they'll owe some money for them. Another derivative instrument, bit too complicated to go through for today, and then some provisions. So these are things where they think they will need some money for. So it could be all sorts of different things in there. That could be storing money up for different people that they were getting rid of, or refurbishments of a store, or dilapidations, or all sorts of things that they could, lawsuits, all sorts of things they could be paying in there. But you can see there their net current liabilities are just under a billion in there. So it's got a very long balance sheet, as you'd expect, because it's such a big business. But then you've got the non-current liabilities. So these are things that are over a year. So you've got a few things in there, but it's mostly the leases in there that are over a longer period of time. And then that gives you your net assets. So you've got so just on the balance sheet, there is 4 billion worth of assets on there. And as I said before, balance sheets always balance. So you've got 4 billion of net assets, which is your assets less your current liabilities. And that's made up of share capital. So that's money that people have purchased for shares and have gone into the business. So 2.9 billion. And then you've also got retained earnings. So year on year where they've had profits, that gets built up. And they've already got 1.1 that they've built up, but hasn't been distributed. If they did dividends, that would reduce it down. I mean, they do dividends, but obviously they don't distribute everything out, because they obviously need a certain amount of money in to keep servicing the business and keeping it going. So they're very wise and keep some reserves there for trading. So that's a very large balance sheet, but again, you will probably have similar in some ways, some of those things, some of them perhaps not, but most of you will have some sort of fixed asset up in those non-current assets. So that will be things like, a computer, might be your office or your warehouse. And in your debtors, you'll have your trade debtors and hopefully some cash. And then your current liabilities, you'll have, taxes that you owe, suppliers that you owe, etc. What's always good is you want to hopefully have positive funds. If you had negative, you'd always have to do a going concern statement. But obviously this is all positive, so it's all good. So other useful reports that I thought might be useful to mention. So we were looking at financial reports there. Those are the statutory accounts. But you can also have management accounts. So management accounts usually will have the things that are already in there, but on perhaps a monthly basis. So they will have, your income statement and your balance sheet, but also can have lots of other relevant information. I've just given a couple examples here. So, include top 10 clients, include your client concentration. And I find that any of the clients that do this on a monthly basis, they really understand their numbers, they get on top of them, and they can take action to improve things in their business. So always a thumbs up for management accounts. Also, if I'm on my, if I've got my succession planning hat on, it's always much easier to sell the businesses that have got monthly management accounts, because it's much easier for the buyer to see what they're actually buying. If they're just looking at some accounts which are, from March 2024, that's so out of date. It's 13 months ago. They want to see what is the latest numbers. Then you've also got key performance indicators. They might be part of your management accounts or might be a separate report. I've just put a few examples in there, like client satisfaction, new clients, number of leads, utilisation. So that's utilisation. So that's more like for service businesses generally. But it could also be if you are producing products, it might be utilisation of your machinery, performance of your factories, of how much throughput you've got, etc. I thought it was worthwhile. I wrote a post about this a couple of weeks ago. I do find a lot of people think, oh yeah, great, my business is profitable, but they're not actually putting in all the real costs. So I've just thought it might be useful to just to remind you of this when you're thinking about your finances. So I've got here an example: revenue of £1 million, lovely, nice revenue. Costs, significant cost here, 980,000. The director, in this instance, been advised just take a small director salary for tax reasons. So he has 9,000, but it's still giving you a profit of 20,000. So yeah, it's not a huge profit, but it's profit. So the client's probably thinking, yeah, I'm a profit, great. However, if they truly thought about if they had to replace themselves, what is their true value? So if, for example, in this scenario, we've said actually the market rate for that particular director was 75,000, actually what you've got here is a limited company that actually had essentially a loss of 46,000. I point this out for 2 reasons. Well, 3 reasons. I'll always add up more. One, you really do need to understand if your business is profitable, benchmarking it to others, etc., seeing if it is good. Second, I do think in management accounts, it's useful to put in a notional proper salary so that you're not kidding yourself about your profit levels. And thirdly, this is really important when you come to actually sell your business, because your valuation for your business, most times, not always, will be on an adjusted profit figure. And the adjusted profit figure will take into account if they had to replace you for a full-time person and what it would be. So if you end up with a negative, you're not going to get a big valuation. So it's just, I think it's just important to put that there. Finally, I just thought I would post a few things about terms that are different between sole traders versus limited companies. So in limited companies, you're as director, you'll have your director's salary, director's expenses, dividends, pensions. So your money that you're having from the business is probably in lots of different areas. And so when you're looking at remuneration, you want to be looking at all of that. Sole trader is a little bit different. You're taking drawings out, but you're actually being taxed differently. You're being taxed on your net profit, not on your drawings. Now, there may be some expenses that you've been able to recharge in your sole trader business, but the expenses are slightly different what you can claim in a sole trader versus a limited company. So I'm just drawing attention to the fact of, again, you're not always comparing apples with apples. So if you are looking at differences between the businesses, do have a look. It's surprising how many actually nowadays, I'm finding that the threshold for being a limited company is getting higher and higher. So when you're thinking about your structure for your business, do have a serious conversation with your accountant or tax advisor on the structure. But I just thought I'd mention a few of those terms because so many times people say their salary when they mean their drawings, or they'll say their dividends when they mean their salary. And there is really important legal and tax differences to these things. If you think director salary, that gets taxed through PAYE. Director expenses, there's no tax. Dividends, that gets taxed on your tax return. Pensions, hopefully doesn't have any tax at all. So it's a nice tax efficient investment. But sole trader, you're taxed on the net profit. So but even if you've not taken anything out, even if you've taken out 0 drawings, you will be taxed on your net profit. So very, very important to understand the terms and what you're talking about. Okay, that's it. I haven't had any questions. Perhaps it's because I've answered absolutely everything. If you have got anything, that's great. Thank you, Tim. Lovely comment there. Hopefully that's been a few new things for everybody. If you do have any questions you didn't want to ask in this forum, no problem, or perhaps you're watching it later on YouTube or LinkedIn, but you're not watching LinkedIn live, you're watching it on LinkedIn later. Do not hesitate to contact me. Contact me through, if you're wanting to talk about account stuff, do call me through the Gorringe office. My Gorringe emails nikki.larkin@gorringe.email. Or alternatively, if you want to talk about business exits, do contact me nikki.larkin@succession-planning.co.uk. Anyway, have a wonderful weekend. Hopefully you're having a nice long weekend, enjoying the Easter break. Obviously it's Good Friday next week. We will be talking about acquisition planning in the following one, so 2 weeks today. I've just finished an acquisition for my group, so first-hand experience of the good, the bad and the ugly, so I thought I would share that with you. So thank you so much. Have a lovely weekend.